All right, so you're purchasing your first property, or maybe one of the first few properties. You're new to investing entirely or just to real estate. Let's talk about the difference between investing in a long-term rental and a pad split property, because I get this question quite a bit. Like, what is the best way to go? Everybody just thinks, when you think of rental, you think long-term rental. That's just the traditional thing. It's been around for decades and decades, and it's worked. It just has. It's very simple. I mean, there's things that can complicate even that, but it's far simpler than a pad split or an Airbnb, for example. So let's talk about this. All right, let's just do a simple pros and cons list real quick and get that out of the way. So obviously these are averages, and there's nightmare situations and golden situations with both. But you have lower wear and tear versus multiple occupants, and you have easier insurance and financing options, widely accepted by many cities and HOAs. Even if there is a cap or a percentage cap or some restrictions from the HOA, far more of them are willing to allow long-term rentals than any amount of pad split. And then you have stable tenancy, because renewals can stretch between 2 to 3 years, sometimes far longer. I mean, you've seen the tenant that's been there for 10 years, and we'll get to the cons. You know, sometimes they can stay 1 year and that churn. But you have a cleaner exit too. So whenever you're ready to sell, if you are holding for 5 years, you get the tenant out, boom, ready to sell after a simple turn. You don't have to do any deconversions. And with long-term rentals, with the cons, we have one door, which also means while it can stretch, each term can stretch longer and longer, we do have only one stream of income. So if that tenant decides to leave, you have zero income for a month or 2 or 3 or however long it takes to fill that up again. So vacancy is 100% when there's nobody there. Cash flow can be very thin in Tampa Bay with today's prices, taxes, and insurance. And let's touch on that real quick, because we've had taxes go up and up. We've had property taxes. We've had insurance, which for the first time in like forever, I've had a drop, personally had a drop of $200 this year, as opposed to $500 increase for like a couple years in a row, it seems. So that's pretty good for the future. But overall, taxes and insurance are very high. And then interest rates have come down a little bit. We saw the Fed chair meet the other day, but now they're saying that they won't reduce again in December, potentially. I don't know. I think that we are seeing rates come down over the last year or so, but it's very slow. And overall, just rents have not risen enough. Long-term rents have not risen enough to compensate for those factors and a few other smaller ones. So we have cash flow is just very nearly. You can't leverage 20% into a long-term rental and expect to break even. So that's kind of where we're at right now. And I'll show you that later. Rent bumps. So rent increases only happen at renewal, which means there's slower income growth. And oftentimes you're not renewing to the full market rate with a tenant because you value them being there. You don't want to get that turn hit and spend $1,000 or $300 or whatever it is, even a couple hundred, and be vacant for a month or 2 or 3. So and then you pay another tenant placement fee for the new tenant. And many property managers charge 50 to 100% of their first month's rent for a tenant placement fee. So finding a new tenant is very expensive. You're far better to renew the same one at $25 increase versus a $75 increase. And that's also why we have so many duplexes and tris and quads and all these multifamily properties nearby that have tenants that are paying hundreds of dollars under market rate, because over the years, that just stacks and stacks. So if a tenant stops paying rent, an eviction pauses all income as well. So just keep that in mind. Kind of all these scenarios, long-term rentals are very simple. And that's in a way a con. So with pad split, we have the pros. We have higher gross and net potential by renting each bedroom, and we're diversifying the income. So even though it's one property, there are multiple tenants paying. So we have one vacancy only loses a fraction of the total. And while yes, you may have vacancies more often, you may have people staying for less than a year on average, or about a year on average. That vacancy, you're still going to have money coming in paying the bills at all times. And then we have a very strong demand for affordable rooms in Tampa Bay, as we've seen how expensive studio apartments and 1 bedrooms are. It's crazy expensive. So it's like $1,100 or $1,200 for a studio where you have to pay utilities half the time, or you can go pay $800 a month or $850 a month, all utilities included, including internet, and you don't have to pay deposits to get all that stuff set up. You just like it's like you're on Airbnb. You just book a room. You do have to get vetted, and there's a pre-approval process. So it's not like I'm just saying you can pay money and walk into one whenever you want, but it is far simpler than like renting out a single family house. So it's a lot quicker to get somebody in some of these cases if you're in the right zip code. And so because it's so easy to get into some of these rooms, I think the flexible pricing and the ease of getting in the weekly pay is just like it's almost a no-brainer for a lot of people who are just looking for that type of thing. We also have with Padsplit, you have platform help with marketing and screening and payments. So again, they act almost as Airbnb does. I'm kind of using that as an analogy because most people understand how that works now. They're going to basically vet your people for you. They're going to be the rent collectors and the distributions of your profits each month. And they're also going to be the platform where people submit maintenance requests and a couple other things. So there's a lot of things that you have with that platform instead of just like typing onto Zillow and listing your room for rent, which they allow now. You can get anybody, and then it's a much quicker and simpler. Like just take advantage of their marketing as well. With Padsplit cons, because it's not perfect, there is more management. There's far more people. There's more messages, more complaints between members probably, and there's more turnovers. So we are able to operate or navigate through all of that. It's not as scary as it may seem, but it is a con compared to the long-term rentals. There are higher operating costs. I mean, for one, you're paying the platform itself, which is 8%, and then you have a separate property manager doing the in-person day-to-day stuff. There's utilities you're covering. There's the initial furnishing. There's initial conversion. And when I say conversion, I don't mean like you're basically just putting up additional interior walls and doors, and they can be pressurized walls that don't actually, that pressurizes and they expand to the ceiling, the floor, and outer walls. So they're very temporary and don't require permits. And then there are other things like there's cleanings. Like a lot of people will pay for a monthly cleaning, and it's a good thing to do, I think. There's the internet costs. You're paying for internet for everybody. So just keep in mind, like all these things, and with the furnishing I touched on, you're not furnishing it like an Airbnb would. So, you're not really going to be spending $20,000 on decor and nice couches and outdoor furniture, like, tables and stuff. Most of it's just bed frames and mattresses and desks and stuff like that in individual rooms to make them more comfortable and convenient for their at-home work or whatever they're doing. So there's other things with Padsplit. There's we must keep in mind of the local rules, occupancy limits. We have to keep in mind parking, make sure there's enough at each house, and HOAs are basically always a no-no. I do think that Padsplits likely will incur more maintenance and a larger maintenance reserve, but because of the far higher gross income, I think you can still keep about 5% reserve for both properties, because a 5% reserve at $6,000 a month is a lot more than $5,000 reserve at $2,500 a month. So percent wise, I don't think you really need to change that. I think it'll correlate to the amount of rents you're collecting. We have the resale and exit, which is still, nobody's really selling these right now. There have been a few, and I'm sure there's a few every year, but more people right now are buying because it's such a newer thing. Nobody has owned a Padsplit in Tampa for 10 years, or even, I don't even know if it's been technically 5 years, maybe 5 or 6 at the most. So I think most people are still in the holding phase and the growth and purchase phase, and not too many people are offloading yet. So in my opinion, I think the resale and exit is going to be very simple and smooth. I think as you see people buying operational Airbnbs as almost like a business, there will be those people who are interested in that as a Padsplit as well, because you don't have to go in and pay for the furnishing and the initial conversion. Everything is already set up for you. And not that you can charge a premium. I don't know if you will be at that point in time when you're ready to exit, but there is a chance you could. because all that work has been done and there's a history there. So you might be able to sell it less as the underlying asset and more as the like an income approach. So here's where each one shines. And I'm going to do a simple numbers thing and a comparison for you a little bit later for a property in the 300-ish range. So you can see, most people have about enough money to pay for the 20% down on a $300,000 starter home in Tampa. So we'll see what that looks like for each rental strategy. So where each property shines, I think if you want something that is it's like a low touch and it's steady, it's finance friendly, and it's a very simple and easy resell and easy to manage thing even for yourself sometimes, I think you need to pick a long term. Now just keep in mind, I really would recommend you pay more than the 20% down. You put down more than that, like 30 to 40, if you want to break even and start just give you enough cushion and some cash flow starting the next year. I think that's probably what you want to do. But a lot of people they don't want to put more than 20% down. So I get it. This is why we're talking about Padsplit now. If you want something that's going to maximize cash flow from a single house, and you'll probably have to hire, a property manager, but operate it like a small business, I think Padsplit is what you want. Now, that's not to say that you have to invest solely in Padsplit properties. I think there's actually a very good argument that you should build a portfolio, and you should probably add a Padsplit or two to it, depending on how many properties and how large it is already. But that high income will help offset other expenses from other properties. So if you get a couple Padsplit properties, it may be wise to go ahead and buy a long-term rental, and you can withstand a little bit of negative cash flow for a year or two because those other ones are producing so much. But for those people who are starting out and you don't have properties already bringing in income, it makes sense to start out with a Padsplit, so you actually have some income coming in versus negative cash flow. And nobody believes me really when I tell them there is negative cash flow in single families right now, unless you're putting 40% down. So I'm going to show you here in a second. All right, I'm just going to show you we're going to look for a property. We are going to look for a property in Tampa, and we're going to do a non-flood zone property. So that's what everybody wants, right? No flood zones. We'll do a $300,000 to $350,000 house. I'm going to look for it, and we'll find one in a second. And I'm not going to do too many filters here. I just want to keep, let's do Hillsborough County. Still a lot of properties to look through. So, no HOA. That is the one that I should do. And no CDD. Community Development District. So do not want those as well. And we do want something that's at least, 1,600 square feet probably. You know what? I might as well just do all these filters because I'm not going to find what I want right away. So unless I do this, we'll do a block exterior. All right, there's only 9 properties. All right, look at this one. All right, boom, found it. Okay, so we're going to do this property. This is a $325,000 property. I'm going to go ahead and pull rent comps on it live from my other MLS sheet right here. And we're going to be looking at long-term rental comps here. And this is a 4-bed. Okay, I mean, it looks like, let's look at some photos just to verify condition. It's not great. Not really great. Okay, so it just needs some flooring work, like new flooring. And like, I don't know, maybe new paint. And put some of these doors back up. It has kind of like an older feel to it, like an kind of older deferred maintenance feel. But some like painted wood paneling over there. Yeah, like needs new flooring where the tile is at a minimum, and then new paint at a minimum. And let me just compare this with, and like pressure washing out here for sure. Ooh. I'd say this is close to, I mean, like kind of close to turnkey, maybe not exactly, with the flooring, but okay. So what we're going to do is, it looks to me like there's another property nearby within like half a mile that has a little bit nicer, rented for $25.50. So after you paint and do flooring, this will look like a pretty nice house. That kitchen does not look bad. The backsplash is interesting. Not granite. Oh, you know what? All right, I take this property back. There's a lot of, if you can see my mouse right there, these cabinet looks like they're falling apart. It's from mica countertops, not granite. I think you probably might need to do a new kitchen once you start opening these cabinets up. We're just going to plug it into my calculator here, and we'll just compare Padsplit versus long-term rental, including all the work. So it'll be apples to apples. So purchase price, let's just put in the ask there. Budget, I think no matter how you do it, you're going to be doing the same for both properties. So the budget will be about the same for like the flooring, the paint, and the kitchen, we'll say. So let's add in kitchen. If you were to redo it entirely, which I just don't know, I feel like you might be able to get away with adding granite to the countertops and repairing them. So let's just assume that's the case. Let's just say like $7,000 for that. And maybe new hardware is in there as well. Let's do new paint, probably maybe 4 to 5,000 there. And then flooring, probably 1,800 square feet times $10,000. So 21. Well, let's put 21,000. Keep it simple. And then for Padsplit, we're going to have about, I think with this house, was there a layout here? I think with this house and this layout, you can probably get about 7 or 8 rooms. So I'll look at it both ways. And you're probably looking at about $12,000 for furnishing it, the setup cost for that. And then we also have the other difference between this is setting up the walls and doors. So there's probably another $8,000 involved with putting up the walls and doors to make some of these additional, like 4 additional bedrooms. So, and I could be wrong on this, right? But we're just going to kind of assume that's the case for now. And well, let's just even add a little bit more money. Let's put 25,000 to be safe. So 25,000, that's just an extra expense up front for Padsplit. So let's do that. Financing costs, this is pretty average right now, 6.75%, 20% down on both, and not using a HELOC. Long-term property management is 8, and Padsplit, we're going to put 6. I think it's going to be about closer to 6 on this one. But Padsplit, we're going to have average of like European utilities. So let's add these in real quick. And feel free to skip forward to the final conclusion if you want, but we're going to put about $160 a month for water, sewer, trash. This is 8 bedrooms, not 10 or 12. Internet. So you can see we marked true versus false, and long term is all false. So here's our monthly cleaning for Padsplit. Let's go down to long term. I think the rental rate for this one is probably going to be closer to like $23.50. It could be a little bit higher, but I think that'll actually get you a renter pretty quick, and you're not going to have a high vacancy. So we can even reduce vacancy probably a little bit to 3%. Listen, even if we push this to $24.50, which is $100 under the nicer property, I think that property is just too nice to be a rental comp for, like, to be so close to this one. They had a very nice updated kitchen, wood flooring throughout, like hardwood flooring throughout. Bathrooms are beautiful. Porch, everything, all that. So I think $23.50 is probably the right number here. Maintenance reserves, CapEx, might have to bump that up to 3. I don't know if it has how old the roof for HVAC is currently. And of course that'll affect numbers, but it'll affect them evenly. We have negative $500 a month cash flow for this long-term rental. And this is a pretty good area for rental properties. There's a lot of rentals here. Now, if you exclude the reserves, you have still negative $250 a month. So you're out of pocket even on a good month. And that's how I look at it. On some good months, it would be nice if your cash flow looked positive, even if you were withholding for reserves. but that's not really the case here. Let's go to Padsplit. Let's put in 7 bedrooms just to be generous here, because maybe we can't get 8. And let's just look up the Padsplit market. Where is it here? Hang on. Here we go. Padsplit map. It's what I use for some of the data. This is oh, okay. Now it is working. A good little quick indicator of where a zip code is at any given time. This is 33612. Okay, I don't know what's going on here. Says Tampa right now has 2,118 active rooms, which is kind of crazy. For some reason, this is not working. Let's try this. Okay. You can see the demand. 11,000 searches in the past 30 days. Okay, unfortunately, this map is not working right now. It should be outlining all the zip codes. But I know where the zip code has been in the past. So what we're going to do is we're going to put $185 a week for the average weekly rate by room. And we'll lower the occupancy to 85, though I think it is 90, just to be kind of a little bit generous here. We have turnover and cleaning per room is $40 per room. So when a tenant leaves after 8 months, you're paying the property manager, her cleaner, whatever, about $40 as of right now to basically turn the room if it's just a basic generic turn. So that's not very expensive, but you'll be able to see where it adds up over time. And then the platform fee, which goes to Padsplit. And let's do this. So we're going to estimate about 7 rooms, and we'll assume that they all stay about 1 year, which is a little bit longer. You can increase this to, 12 if you think that they'll stay a shorter duration of time. So you have more turnovers per year, more move-outs. This is also calculating the tenant placement fee to Padsplit. Unfortunately, I have not built that into my long-term rental. So that is actually a difference that I should probably figure out how to add into the analysis for the long-term rental page, because that's a really good fee. That's a big fee you need to remember. So we have here, we'll put this back to 7. We have cash flow. $100 a month, $105 after your reserves. So this is already factoring in the high vacancy, the maintenance and reserves at 5%. Now let's see what happens if we add in 8 bedrooms. $550 a month cash flow. So if you can get 8 bedrooms here, it's a pretty slamming deal. Sure, it's not the highest cash on cash in the world, but it's far better than any long-term rental you can find. So let's also compare the total cash invested, which is a little bit of the cash on cash return is pulling from the total cash invested, which is like the rehab, the one-time fee. So $116,000 here for Padsplit because of the additional costs, and $91,000 for the long-term rental. So just keep in mind, if you go the Padsplit route, you do need money after closing, and often it's $20,000+ at a minimum. So because you need furnishing and walls, doors, locks, all that type of thing to get it ready to go. So I hope you've enjoyed this. You can see the cash on cash is actually negative, which is not great because you are taking a loss each month. Now before I let you go, I want to show you what it looks like if you do the equity modeling. Well, actually, what's a better way to show this is the IRR, the internal rate of return. Let's go to the all right, let's see. Property appreciation 4% per year. That's correct. NOI growth 2.5 over a 10-year period. So let's see. The internal rate of return for the long-term rental is almost 6%. And let's see what what I could change is, let's change the after repair value, because since you're doing the flooring and like the kitchen and stuff, you are improving the value of the home. So let's just say it's worth $350. And so that's what we're going to base the starting point of the internal rate of return on. So your internal rate of return is probably closer to 7.5% for a long-term rental, and it's 14% for a pad split. So that is basically collecting all of the income each year from each property, or from either property each month. It's paying down the debt, and it's also building your equity and the appreciation, and then it's taking the proceeds from your sale at the end of year 10. And so that's how that's how the internal rate of return is calculated. And I think it's the most full picture way of looking at your property, your investment. Please like, comment, and subscribe, and let me know if you have any questions about Padsplit or rentals or real estate below so I can answer them at another time. Thanks for watching again.